Yeah, I really have to say, I enjoyed the morning myself, It's always amazing for somebody who is not a scientist, what biotechnology can all do, the depth and breadth of his company, not only in services, but also in products, I think is quite amazing. And also it reminded me, how fortunate I am really to be able to work with very talented and intelligent people day by day. It's not a given, I would say. And the interesting thing about Brain is that not only the people are very talented and intelligent, many of them are also driven. They're driven really by a purpose to change the world. So really people want to make an impact. They want to make an impact on better food, doing changes to the environment, helping to produce differently, more efficiently, more sustainable, and from time to time we can even cure rare disease, which I think is pretty cool. And I think that is something which intrigued most stakeholders to Brain for a very long time. Might it be the employees, the neighbors next door, or you as the investors, yeah? And what Aaron and me have tried very hard the last couple of years, and that's the way we will continue to do, is to add another layer of sustainability to it, if you want so, which is sustained finances, i.e. we want to have a clear path of growth, of profitable growth, a path to profitability, and on top of that, ultimately to generate enough cash flow to provide a lot of the cool things we can do to the world. And in the next 15 minutes or so, I'm trying to explain a bit how we try to get there. If I talk about executing Vision 100, that really is reaching 100 million of revenues. And that is a sweet spot for us. That brings us on the top 10 companies in the world for enzymes. And that is the spot exactly where we want to be. We don't want to end there, but we want to get there. That's the intermediate target. The prerequisites to get there, obviously, is growth. So we need about 15% average annual CAGR roundabout to get there in the next 5 years. We aspire to grow high single-digit, low double-digit organically, and add the remainder by M&A, bolt-on acquisitions. That's the idea here. Not only to grow on revenues, but to grow profitably means having positive operating leverage. So we try to increase the EBITDA margin about 100 basis points year by year by year by year. Will not be every year, sometimes it will be 70, next will be 120, something like that. But on the path, on the CAGR, about 100 basis points per year for the next 5 years to get us to about the 15% target level that is for Brain biocatalysts only, so the major business we are running. That would not be possible if you wouldn't be active in attractive markets, which means markets with secular growth, but also attractive margin profile, and particularly in the niches we are active in, we think we can get attractive margins here. We just started to harvest the bioincubator. We will continue that. Very consequentially, we're trying to get commercialization profits out of the bioincubator to finance that future. That's clearly part of our strategy. And last but not least, we think we have a very, very good value proposition to you as shareholders. We are really a provider of biosolutions and bioproducts to the market, which is based on a combined technology platform with very strong USPs. And I think Alex has alluded quite nicely on that, what we all have here. And also the production side, we have some very exciting technology as well, which Andy pointed out. Before we now look further in the future, I think it's worth pausing for a minute to think about the past, because obviously we had also to put in some foundations for that growth. And what we really have tried to do in the last couple of years is take out complexity out of the organization and reduce costs. An absolute prerequisite to get to an efficient organization and to get to efficient corporate structure and harvest the synergies was to buy out the minorities. Because quite frankly, if you merge things at book values, you leave a lot of the value upside for the minority shareholders. We don't want to do that. We want to give that value uplift to you. So we had essentially to clean up the minority positions before we could put the business together and harvest the synergies we should actually finally get out of that combined entity. Secondly, we have significantly simplified the corporate structure and taken out costs. I've reduced the number of entities from 18 to 7 now over the last 1.5 years. While that might not be a big number to you, it means maybe 50,000 euros each for tax advice, the auditors, running it, let alone the management times it takes to run all of these entities. So multiply maybe 9 times 50,000, almost 500,000 by the size of Brain. That is a lot to shift. We optimize the tax structure, because particularly for the royalty pharma deal we have done, we need to find a structure which is tax efficient for us, because we want to keep as much cash in the company as we can. And if you see that Brain Biotech AG has about 85 million of tax loss carried forward on the last reported year, you can imagine we want to use as much as we can of this tax loss carried forward against the future royalty income which we expect from the transaction. And to put it a bit graphically, everything that's the black crosses we have already closed. Where the gray cross is, that's something still to be done. And the last thing we have done is we merged now US entities with Biosun and Biocatalyst Inc. in the United States to have one combined customer offering there as well. But we don't want to stop there. We still want to reform the organization, and Erin already pointed that out. So we're going from a 3-pillar structure plus a holding structure to a 2-pillar structure plus holding. I would almost say we put together what naturally belongs together, i.e. the science-based business on microorganisms and enzymes with a production business of enzymes, i.e. moving Brain Swingenberg of around 6 million revenues to the bioproducts division, and moving the analyticon business, which is different in nature, to the other businesses which are different in nature, i.e. to the right-hand side, to the bioincubator, which at the reporting year 22-23, that's the last reporting year we put it out, had 6.4 million of revenues. If you look now at the pro forma structure, how that structure would look, again, business years 22-23, last reported numbers, and we have taken out Acribium Therapeutics for better comparison because it will not be with us going forward. The Brain Biocatalyst would be quite a nice unit of 48 million revenues, about 5.5 million adjusted EBITDA, so a good starting margin, and a target R&D ratio around 4 to 6%. On the Brain Incubator, about 6.5 million recurring revenues, but fully coming out of Analyticon essentially, plus some very strong potential in the future to realize project revenues from that pipeline once we start booking particularly the royalty pharma income here. Also here we keep investing around 3 to 4% of target ratio of R&D. If you combine the two target ratios, we're talking about 7 to 10% of group R&D, which we feel very comfortable with for our size of a company to stay innovative, to do the right things for the future without killing the shop. If you look at now in a different way, i.e. by business model, how do we try to drive value in these divisions? And very clearly is for us, we will not have divisions who don't contribute to value creation. So on Brain Biocatalyst, very clearly, we have a unique customer offering. We are an integrated biosolutions and bioproducts provider, which can do everything from discovery over manufacturing to the finished products for our clients. Our go-to business models, and I think we very clearly elaborate on this, are enzyme products. We have a contract research organization and a contract manufacturing organization of 3 ways to go to customers. We have a very strong shared technology platform. So everything we'll do in the future will be based on that technology platform and venture out in different things for it. We're looking at high organic growth, as pointed out before, plus some bolt-on M&A. And of course, we're looking at positive operating leverage by increasing the EBITDA margins year by year. On the incubator, again, looking for disruptive innovations. We have just successfully started to commercialize this platform. We will do so in the future. We are looking at really creating more and more licensing income for the company because we have a great technology base. We should be able to get much more licensing income out of that. Very important for you to understand, we are not a venture capitalist, yeah? We are technology heavy, capital light. We will be a technology provider, not a capital provider. Hence, everything we do in the incubator, we will be trying to do with partners, either out licensing or have a partner for the development. It makes them go to market quicker, it makes the way to market more secure, and it's risk sharing, cost sharing, which we need because we are not the best people in everything we do. And last but not least, we will keep investing as a reasonable level in the technology, particularly here with licensing platforms. Also, the holding, of course, needs to contribute to value. By active portfolio management, we will facilitate essentially the cross-divisional synergies, look at the M&A process, and also be ready, of course, for strategic financing. And I would say the royalty pharma transaction is such an example of that, is strategic financing for the group. Now let me come to our 5-year targets. And of course, with the new structure, we also needed to update these 5-year targets for the structure. We will change, we will guide in the future, i.e. we will guide on the dependable business, which is the Brain Biocatalyst business in the midterm, and give you a yearly guidance on the Brain Bioincubator, who's by the nature of a business more volatile. So looking alone at Brain Biocatalysts, we are forecasting now in the next 5 years 100 million of revenues, only for the division, an adjusted EBITDA margin of 15%, and an R&D ratio for the division of 4 to 6% of group sales. CapEx, and that is regular operational maintenance CapEx, plus some expansionary CapEx for the PEF, around 3 to 4 million per year. If you have to do another haul or something, that's something on top, but around that range, we are quite comfortable. On top of that comes the brain bioincubator, where we will see significant revenue and earnings potential the next year to come, particularly once we start harvesting the Royalty Pharma deal, and again with an R&D ratio of 3 to 4%, bringing group R&D to 7 to 10%. I think what should be quite clear is these are not only updated targets, they're also upgraded targets, because essentially we guide now only to one division, and we want to deliver the full growth of that division of the old targets in the one division within the next 5 years time frame. Everything out of a brain bioincubator would come on top of that. I cannot exactly tell you now on what year it will come, but I can tell you we have a good probability it will come. So from that point of view, we will guide you closer to the actual years when we're going to harvest these revenues. Now, I'll give you a bit more insight how we're trying to grow sales and how we're trying to grow EBITDA with more granularity on it. Essentially, we expect the base business we have today to grow alongside a bit higher than GDP. So grow with GDP, win some market share. The new products business, and I think Aaron alluded very nicely to the funnel, how we try to get there. Darren gave you some very nice examples, what we launched, what we're trying to do. We expect high growth out of new own launch products. Geographic expansion plays a key, particularly in North America, maybe also the MENA region. We're looking clearly to grow in different segments. So, for example, life sciences launch has been a very good example of that. The contract manufacturing organization, we're talking about modest growth and picking one up of the questions out of the net before. It is also, of course, to fill the capacity, and we have always a choice to make. Do we manufacture ourselves? Do we manufacture outside? Do we in-source production from other people or not? So we can play with that capacity, and exactly what we want to do. Very important for us is to add more licensing business to the company. So what we alluded to in the past is TMS Plus, we call it now fee and royalty revenue. And you can imagine that that for a science-based company is very important, because other people pay for our technology, we can actually prove we have a great technology position, and we are working very hard on that. And Martin Langer, who actually is in the room right now, I think did a great job in getting some nice contracts into the door in the last 2 years. It will take some time before you see it in terms of our numbers, but the foundation is clearly there. And last but not least, we do expect M&A to add up all of these points before, because otherwise we wouldn't go for an acquisition. Let me take a different view on it. So how do we actually drive margin in these divisions? Well, on the base business is clearly working day in, day out on the mix improvements, really harvesting the procurement synergies. We are getting into nice sweet spots right now in terms of size, which is quite good for us. And we are also trying, of course, getting more and more scale benefits in, particularly out of the procurement. New products clearly will carry higher margins when bought in mixed and blended products, and also with more own production. We will utilize the fermenters better, so getting to 100% utilization is actually what we achieve, of course, when try to optimize the fermenters. Geographic expansion is also very interesting from a margins perspective, because particularly in North America, the margins on enzymes are much higher than they are in Europe. So even though you incur some shipping costs, some handling costs, let's hope Mr. Trump doesn't kill the business. Essentially, there is going to be some money to be made in the United States for us, also from a margin perspective. Life sciences, diagnostic, pharma, much higher margin markets. So as Darren said before, low volume, high price. So also something that will drive the margins. On the CMO business, the contract manufacturing, it's clearly about maximize the fermenter utilization we have, so the capacity, and smart debottlenecking. So invest in better strains, invest in better downstream processing, try to fill the fermenters quicker, get cleaning quicker, things like that, to really sweat the assets to a certain extent and increase capacity without investing in further steel. That's the strategy here. Well, fee and royalty revenue, pretty clear. All license revenues will fall immediately to the bottom line. So if the share proportion increases of sales, it will drive the margins without any doubt. And last but not least, again, M&A we won't do if it doesn't add to the points above or is not accretive per se. Let me quickly jump to the brain bioincubator. I mean, we have been able to close 2 benchmark transactions this year of a size we have never seen before at Brain. The first transaction, Royalty Pharma deocryptament, is a transaction who can bring to Brain about 138 million of revenues. 18.41 of these revenues are already booked on our accounts today. You will see them in the full year numbers quite nicely. We are entitled to another 18.42 million of milestones from the Royalty Pharma transactions, and another 9 million milestones directly from Pharvaris. So we're talking 27 million. I cannot exactly tell you when they come, but they will come along the clinical development up to registration of a product. We are now on the start of phase 3. Take your best guess, 2 to 3 years. Yeah? So in that time frame, we are entitled to 27 million additional cash, which again, by the size of Brain, is very high. On top of that, once we enter then the sales phase of the product, we could get up to another 92 million of sales-related royalties. So I think we have tried to do a deal where we get as much cash upfront as we can, do that in a tax-optimized ways, but still basically benefit from the product over the very long runtime of these pharma products. The second transactions, and also something I'm very proud of, we have been able to find an investor base for Acribion Therapeutics. That is to license out the brain-engineered CAS, the GDSE technology, for the use in pharmaceutical applications, particularly oncology, to a venture capital finance consortium. What that will do in the long term is it allows us to get up to 92 million of regulatory milestones, and additionally, we could get royalties on net sales. What it will do to us in the short term is also very important. It will reduce our cost base significantly. We can take out about 15, 16 people, plus some additional cost, of course, with outside services. So talking about 1.5 to 2 million initial cost savings in year 1, which started on the 1st of December. So the team already is working for the new co and not on our payroll anymore. And that has been a fantastic deal from our point of view because it reduces the cost now, it leaves the long-term potential, and it gives the new team, which is also important, much more money to quickly get quicker to the market in a very exciting technology. Also very importantly, we have not given the patents away. The patents stay with Brain, we have just licensed out the technology, and there's a big difference in that. Because we can still use all applications outside the exclusively licensed fields to other application possibilities inside and outside Brain. But of course, we don't want to stop here, right? But we still have a future commercialization projects. We want to continue with them. And one is BioGold, and I'm quite happy actually to hold the first BioGold nugget in my hand, who has been commercially produced, so out of our bioextractor at a partner, which we hopefully can announce soon. And always amazes me that that thing is worth about 1,800 euros, but okay. Gold has a high price right now. But also Prasein, so the natural sweetener compound is still in development, SolarScure, and Aaron gave you a hint that here financing has been secured now for an extension study, and some new projects we might as well also add to the pipelines going forward. Let me talk a bit about M&A. I mean, M&A will be part of our DNA and has been part of our DNA. So I'll give you a bit of an idea that we have been quite busy in a lot of years, my predecessors and myself as well, i.e. we have been buying many companies prior to the IPO and post the IPO. And post the IPO, some very big and meaningful acquisitions, particularly Biocatalyst as a manufacturing platform, and adding on to that Biosun as a springboard to the US, and Biotech as a line extension into baking. We have also taken some corrective measures, i.e. we said we are not a B2C player, so we don't want to be in cosmetics directly with consumers, so we have sold essentially Monte and LA Schmidt, who have been playing in that space. And as I pointed out at the beginning, it was very important to buy it out of minorities to actually get in a position to reap the synergies within the group. So what are our criteria for M&A going forward? First of all, our business M&A criteria is clearly focused B2B only, nothing else. We will be looking at the enzyme business and the products business within enzymes primarily, so not buying tech shops essentially. We're looking at specialty niche applications within the enzyme market, and it either has to have a strong fit with what we do, or it has to be a line extension like Biotech, when essentially we went into a new segment, baking here. Major focus will be Europe or US, but of course we will be screening around for other interesting things. From financial criteria, we are clearly focusing on bolt-on. We're looking to have profitability in line with the existing segment or to achieve this within 2 years. We are clearly looking to have realize strong economies of scale, so either in-source production or have scale economies in terms of procurement. And we look to be at value accretive in 1 to 2 years post synergies on adjusted EBITDA. So I think we have a nice framework we can work with. We have been building a pipeline of things we are looking at it. It takes always more than 1 to tango, so we can't promise when something will happen. But we have, of course, some things in mind to accelerate the growth within the group. If you ask me, should that be a highly valued business model in the equity market, I would clearly say yes. Because first of all, we have a unique positioning. We are bioproducts, biosolutions provider who sells products, who does research, and has a custom manufacturing organization. And on top of that, a quite exciting bioincubator still to commercialize. But why does the equity market normally apply quite high multiples to these kind of models? Because first of all, you have high regulatory entry hurdles. And that's particularly true for life sciences and the food space. High regulations, so it's a nice sticky space. We have specialized niche kind of products with quite attractive margins and attractive growth markets. We have high customer intimacy, so once we are in the customer's products, it's quite sticky. You know, we have the bakers who can tell the industrial bakers how to bake. Don't forget, in the industry, there are no bakers, yeah? They're cheap workers essentially trying to bake the bread automatically, and we need skills, and we can provide these skills. So once you are in, it's good, it's a very sticky business. We have strong technology USPs, and one of the biggest arguments for our customers is that, for example, with our own CRISPR-Cas technology, with plug-and-play strains, if they have a med extra, time to market gets quicker. Quicker time to market means actually it's good for margins. And last but not least, our products have strong value added. While they might only make a small price change to the final product, they make a big functional change to the final product. So it's very high value added for the customers. And on top of that, they usually add a sustainability angle. And if you don't take my word for it, that these things can be highly valued, look at some of our competitors who I think have been done very well over a very long period of time and also have some quite juicy multiples in the equity markets. That brings me always to the end. So why should you invest in Brain? I think we have 5 very strong reasons for that. First of all, we are clearly on the path right now to profitable growth in specialist enzymes. We want to become a top 10 player in the world, and you can be part of that journey. Secondly, we have a large, growing, and accessible markets, and we have all the means and the tools to play in these markets. We have a strong demand right now for integrated biosolutions, not only from the sustainability angle, but also from the fact that many parties out there are trying to look for outsourcing partners, and we can be one of these partners with a strong technology offering. We have still significant chances to commercialize the bioincubator. We just started with the Royalty Pharma deal to get the money into the door. We just started now to do something with Caribbean Therapeutics and have other projects who have, let's say, a maturity stage, which lets you expect they could be commercialized not in the too distant future. And last but not least, I think we have a very strong product offering to make really an impact. I mean, our services and products address at least 6 of the SDGs directly, and Erin showed you a very nice chart to that, which per se I think is also quite an attractive value proposition. Yeah, that brings me to the end, and happy to take any questions.
Thank you, Michael. I have a lot of questions, but I will keep it to 3. My first question is, or my first 2 questions are on your new midterm targets. Mm-hmm. Thanks for providing the details on biocatalyst. What about the bioincubator? So I understand that you don't provide detailed guidance here, mm-hmm. but do you expect that business or that segment to be margin accretive in 5 years?
Totally. I mean, the big problem is, and that's why I'm a bit reluctant to guide that, is it follows along the path of clinical development in some instances, like with SolarScure or particularly also the Royalty Pharma deal. And while I know usually it takes 2 to 4 years, I don't know exactly when that comes. So also not within that 5-year time frame how much we can harvest of that. So I think it would be honest to tell you now a precise guidance on that. The second thing is, we have seen in the case of Royalty Pharma that we have chosen a cash-optimized structure and a tax-optimized structure. i.e. we will book no revenues for a long time, we will book no earnings for a long time. We could have chosen differently, it would have just not been good for cash, so we didn't. Yeah? So depending on how we commercialize things out of a bioincubator, it will make a big impact when we book it and how we book it. So we thought it's much cleaner to guide on what you can measure us against and not guide on something which is a bit arbitrary when it comes from a timing perspective. I'm pretty sure things will come, yeah. So I'm pretty confident on that, and of course, particularly on the largest part of that, i.e. the Royalty Pharma transaction, Pharvaris is listed, so you can look what they do. I mean, it's very transparent in terms of, and every time they say something positive about clinical development, it will actually end up with us at some point of time as well, yeah. But if that's going to be year 24 or 26, I don't really know.
And then your previous margin guidance pointed to 15% plus minus 500 basis points. So essentially you upgraded that margin guidance. What gives you confidence to reach that 15% in 5 years? We have been, let's say, always confident on the 15%, but of course, as the old guidance was on the group, so including the bioincubator, we didn't know how we would exactly commercialize. So if you commercialize in the way we have done it right now, i.e. no impact on margins and sales, something else, we could have also taken the model of licensing, low sales, high margin, or own product, high sales, medium margin. So it's very difficult, and that's why we have taken the 500 basis points up and down. If we now point to the guidance only essentially on brain biocatalysts, we have a much better way of steering that, i.e. what I tried to show you with the indicated things. We have a lot of moving parts, but these moving parts we can influence to a larger extent. So we're quite confident that by changing the mix, by having more own production, by going to different geographies, by adding things like life sciences, by adding scale, getting the synergies out, we have a little flywheel which is running right now, which maybe in 1 year is 50 basis points, in the next maybe 120, so it's not going to be a straight line, but the flywheel goes in the right direction, and we think 15% also looking in what's possible in the market seems to be very possible from our structure. Okay, great. And then lastly, on your cash position or your net debt position, including the Royalty Pharma deal, could you update us on that figure? Well, we had a cash position roughly of about 10-12 million at the 9-month figures, and we have obviously gotten 18.4 million in. So if you add that together, that will come pretty close to the truth. The rest we will tell you in January when we report the numbers. But of course, we will also use some of the money to repay some debt, so that in terms of a net cash position that over time might look a bit different. But I think we're in a strong position right now. And I would also expect the Royalty Pharma program to contribute quite nicely over the next 2 to 3 years. So more to come, essentially alluded to the 27 million, which I'm still expecting, so that we are, I think now, getting not from a defensive position, let's say, in a healthy position, and we could get into the offensive in the next 2 to 3 years.
Thanks also for the great presentation and this very detailed chart. Maybe one question on the margins. You mentioned one of the drivers is the life science, and so from the previous presentation, we understand that's more of the backloaded. So are we to expect like some, let's say, staircase margin improvement with backloaded high step in the end?
Yeah, it could be very much. I mean, as Darren said, it's a long-lived program, so it takes a long time to get there, and they tend to ramp for a slow time, and then obviously with the success of a product, you can have an impact. But I think the life sciences pharma play in 2 things, right? One thing would be own products, the second thing would be in the contract manufacturing organization. So actually growing along with the volumes of the customers, which are not huge volumes, but they could be high value. That's more the idea of growing in these segments, yeah. So yes, of course, we have some fluctuations with customer success, and these projects tend to be longer dated, i.e. more back-end loaded, i.e. we gave you an indicative guidance, not a very granular guidance on it, because of course, it's early stages in that development.
Maybe a second question then. So the 25 million remaining you had on still on the previous slide, 75 million. The rest is what? Is milestone and things like that that will be booked into Biotechnology?
Yeah, it's the TMS Plus fee revenue business. It's licensing business we will be doing. It could be sales of certain things, and so there's a whole bunch of other things we can do. I think what we try to do is to give you really granularity on, let's say, the plannable things of things, and then there is something non-plannable, of course. There's also an unallocated portion in every planning of 5 years, of course, a long planning time, and that's represented in that part, plus M&A basically as another source of growth.
And one last thing, I stop there. On the M&A, could you give us a sense on what will be, let's say, the deal value that you are trying to look for?
Yeah, I think if you look at what we have done recently, i.e. the Biotech acquisition, the Biosan acquisition, that's the kind of things we look for, digestible things. Normally, if we buy something, we tend to keep the old owners engaged for some time, so we tend not to buy 100% at the beginning, just to make sure they stick in and they deliver the targets, and if we get rich, they can get rich, but not the other way around. So usually I would say anything within 3 to 5 million kind of range is something you would be feeling quite comfortable at.
Great, thanks.
Thank you. 2 questions. Question for number 1. Taking into account that the change in the company with new products, new enzymes, new markets, what is the potential on the gross profit level, medium term?
Yeah.
When I look into companies that do maybe highly specific enzymes for diagnostic applications for, let's say, molecular diagnostics or maybe for gene therapeutic applications, they can get up to more than 90%. So what is your expectation in the medium term or long term run?
It's a very valid question. Of course, a rising EBITDA margin would also need a rising gross margin. Otherwise that will not work. Having said that, we have a very diverse portfolio. We have some very, let's say, long-running products with very high margins, with very good knowledge of how we manufacture them. We have some new stuff which has maybe no margin contribution, just ramping up. Baking enzymes have a different contribution margin than fruit juice enzymes, than beer enzymes or brewing enzymes, and so on and so on. So it's very difficult to say in the overall mix, I would say. But clearly is that we're looking very carefully into the gross margin, which has 2 elements, of course. 3 elements: mix, pricing, and purchasing. And with rising volumes, you would expect, of course, to get purchasing volumes, better prices also from the buy-ins we have. We expect, of course, higher efficiencies in many things, and also in terms of procurement in particular. And said the mix should improve also with the addition of the life sciences enzymes. I will not be giving a guidance really on gross margin, but clearly the gross margin has to be propelled quicker than the EBITDA margin, otherwise that doesn't work. Nothing in the web, I see. Well, if not, then I guess the most exciting part is Arian closing up, and you can try some real stuff that Brain does there. So I'll leave it to Arian to say some words.
I don't know what's left, other than to thank you very much for all the great questions. I think we've had some very good questions, and when you're presenting and when you prepare a lot, what you hope for are a lot of questions. So thank you for that. I hope we've been able to show you that we're going into a new phase. And this Brain Bio Catalysts launch is absolutely important to us and for the future of the business. Going from a past from university roots and a set of unrelated acquisitions to an integrated bio-industrial business that has a place, particularly in the enzyme world, but also with ancillary products added to it. So we're excited about it. We hope you are excited about it. We will be guiding in the months and years to come on how that exactly works, but all the things that you mentioned on margin improvement, on mix change, on prices, on choosing the right segments, going into things like life science solutions is absolutely critical for us and a very exciting journey to be on. So with that, I would like to thank you. We're going to have some stuff that we can try. The wine ester, including it's non-alcohol, I think. So most people need to drive. So thank you very much. See you next time, and for sure see you in the conference calls and at the AGM in March. Thank you so much.